Alrighty, y'all, welcome back to the channel. My name is Daniel, and today we're going to be looking at some rather interesting news when it comes to investing and marketing futures. This comes from Rutgers earlier today. Stock pickers reckon it's time to move on from central banks. Now, I find that interesting that they would choose to do such a thing, especially since there are major central banks throughout the world, really. But here we go. Stock market investors are calling time on the idea that the Federal Reserve and other major central banks have their back. Hoping for interest rate cuts by the year's end have evaporated. Given resilient data and sticky inflation, all this is suggesting central banks will instead be inclined to keep borrowing cost around their highest since '07 for some time. So y'all remember what happened in '07? That was the housing bubble, and it popped and people lost trillions of dollars. And so investing firms and other groups are like, the banks can't be relied on anymore. They're making bad bets. They're like bad gamblers. You're going to lose money and you're going to put people at risk. The takeaway for money managers: switch from so-called growth stocks such as tech and focus on businesses that can withstand the end of cheap funding. Banks that benefit from high rates and resources and consumer staples businesses can sell goods at a price that match inflation. Companies that pay high dividends relative to their share prices instead of investing in growth are also favored. Quote, for years we've had a capitalistic world that was highly dependent on central banking policies and, quote, the Fed put, says the head of European equity strategy at UBS. We are rapidly transitioning away from that because they're devaluing stocks and bonds. They want value back. European banking stocks considered a deep value investment because of relatively low price to earning ratios and high-end dividend yield have jumped 24% this year alone. Global equity income funds had their first annual net inflows last year since 2014. Shares in tech firms, which dominated the world's equity markets and rely on cheap money to fund innovation, had a strong start in 2023 on hopes that aggravated rate hikes would soon end as economic cycles decelerated. Unfortunately, they're not doing that. In most Western countries, they're talking about raising interest rates again to, quote, fight inflation. Well, guess what causes inflation? Government spending. Guess who controls the interest rates? Government. Guess who controls central banking? Government. So I'm not surprised that these money managers and these investment firms are like, we're no longer backing your bad bets. We're not. We're going to slowly transition out and bring in good bets, good stocks, good bonds. Excuse me. With policymakers prioritizing the inflation fight and money market pricing, U.S. rates moved above 5% this year. The door on rate cuts soon began to shut. Quote, we're probably not getting a central bank pivot. We're going back to what investments used to be. It is a good investment. It's a good environment for stock picking. Meaning there's no more of these blind bets. Okay? We're going to invest in this, trust or that group or this group or whatever. Even E's are saying, I want to be in control of my 401k. I want to be in control of my retirement because the banks are making bad bets. And I'm not surprised by this pivot. So I just wanted to let y'all know that there's a lot of changes coming in how people invest. It's no longer sitting there waiting for daddy government to give the okay. They're becoming masters of industry again, masters of their own destiny. And I hope that this helps you become the master of your own destiny. And I'm going to see you in the next one.